Welcome to Stat Plus, where we enable smarter conversations wherever you go. In today's video, we're unpacking a crucial but often overlooked issue. Why are microfinance interest rates in India still stuck above 20%, even when the RBI's policy rate has dropped to just 5.5%? Despite the significant strides in India's financial sector over the past decade, microfinance interest rates have persistently remained above the 20% mark, reaching as high as 30% in some cases for well over the last 5 years. What's particularly concerning is that these elevated rates persisted even during periods when the Reserve Bank of India's repo rate plummeted to historic lows of 4% following the pandemic. This stark disparity between the central bank's policy rate and the actual cost of borrowing for rural enterprises highlights a fundamental disconnect in our financial ecosystem. This phenomenon raises serious concerns, particularly given its impact on socio-economically disadvantaged segments, primarily in rural India. Recent data indicates a worrying trend. Delinquency rates in the microfinance sector have risen sharply to over 4% in 2024, doubling from approximately 2% in the previous year. This mounting financial stress primarily affects women's self help groups and small enterprises in rural areas. Precisely, the demographic segments that were meant to benefit from financial inclusion initiatives. Scheduled commercial banks typically avoid direct lending to these grassroots segments, opting instead for an indirect route via non banking financial companies or microfinance institutions. Notably, several MFIs are subsidiaries of larger banks themselves, facilitating an indirect lending channel preferred by banks due to operational complexities inherent in serving rural clients. With the RBI recently easing risk weight norms for NBFC lending, banks are further incentivized to pursue this indirect lending pathway. The banking sector justifies this approach by citing operational challenges unique to rural microfinance. Traditional eligibility mechanisms like credit scores are ineffective in environments where most loans operate on peer to peer basis and remain untracked. The resources required for eligibility verification and repayment collection in rural settings are indeed extensive and atypical. However, there's also an undeniable profitability motivation. The exceptionally high interest rates charged to these borrowers create substantial margins that benefit the entire lending chain. The rising delinquencies reflect broader economic challenges, including reduced government expenditure and slower economic growth in 2024 compared to previous years. This raises a fundamental question. If the overall economy isn't expanding sufficiently, how can rural businesses generate enough incremental revenue to service interest rates that are 4 to 5 times higher than the repo rate? With monetary policy now showing signs of easing, we should theoretically expect microfinance interest rates to decline rapidly since they represent the highest end of the interest rate spectrum. However, there's a significant risk that rate reductions might not materialize for rural borrowers since they have few alternative lending sources and larger banks maintain their reluctance to serve these customers directly. This situation poses a long term risk to India's balanced growth trajectory. When rural businesses face capital costs exceeding 25%, it inevitably hampers the emergence of larger enterprise scale companies from rural areas. This dynamic partly explains why urban contribution to India's GDP has steadily increased to approximately 70% and is projected to rise further in the coming years. While the operational challenges of rural lending are genuine, maintaining such high interest rates represents a major economic opportunity cost, as it severely constrains the growth potential of rural enterprises. It is imperative for both the government and the RBI to implement more effective regulations that ensure capital availability for rural development at reasonable costs. Only by addressing this credit gap can we unlock the full potential of rural India and ensure truly inclusive economic growth. Now let's hear from you. Do you think microfinance interest rates should be capped by regulation or left to market forces? Let us know your thoughts in the comments below. Thanks for watching. If you found this analysis insightful, please like, share, and subscribe to Stat Plus for more updates. Whether you're at work, school, the gym, or catching up with friends over coffee, our content empowers you to contribute meaningfully to conversations on a wide range of topics. Have better conversations wherever you go.